Imagine this. Two retirees, same total savings, same retirement date, same investment returns the entire way through. One of them runs out of tax-efficient options by year 12, forced into higher and higher tax brackets just to cover ordinary expenses. The other is still optimizing, still had room to maneuver, at year 25. Neither of them picked worse investments. Neither of them was less disciplined during their working years. One of them just pulled money from the wrong place first, for decades, without ever realizing there was a wrong order to get it in. My name is EcoSticker, and I spend way too much time thinking about money, the hidden psychological traps of wealth building, and why people spend 30 years obsessing over which accounts to contribute to and about 30 seconds thinking about which order to actually withdraw from them in retirement. And if you want to understand the actual sequencing logic and the specific situations where the standard advice is wrong for you, hit subscribe and give this video a thumbs up if it ends up saving your retirement from an expensive invisible mistake. Here's why this question gets almost no attention compared to the accumulation phase. Contributing to retirement accounts feels active, deliberate, something you're doing on purpose every paycheck. Withdrawing feels passive by comparison, like you're just taking money that's already yours, so why would the order matter? But the order matters enormously, because different accounts get taxed in completely different ways, and pulling from the wrong one first can quietly cost you tens of thousands of dollars over a retirement that might last 3 decades. Before getting into the actual sequencing, it helps to understand what you're sequencing in the first place. Retirement savings generally lives in 3 different tax categories, and each one behaves completely differently when you pull money out. The first is taxable accounts, your standard brokerage account. Money already got taxed before it went in, and you've likely been paying taxes on dividends and gains along the way too. So when you withdraw, you're generally only taxed on the gains portion, not the whole withdrawal, and often at favorable capital gains rates rather than ordinary income rates. The second is tax-deferred accounts, your traditional 401k and traditional IRA. Money went in before taxes, grew untaxed for decades, and every single dollar you withdraw now gets taxed as ordinary income, the same as a paycheck would be. The third is tax-free accounts, your Roth 401k and Roth IRA. Money went in after taxes, grew untaxed, and comes out completely untaxed, no matter how large the balance has grown or how much of it is gains versus original contributions. Same total dollar amount sitting across these 3 buckets can create wildly different tax outcomes depending on which one you pull from, in what order, and how much, which is exactly why the sequencing question ends up mattering as much as it does. Now, why does the order actually create a meaningful difference rather than just being an accounting curiosity? Every dollar of ordinary income you generate in retirement, primarily from tax-deferred withdrawals, stacks on top of your other income and pushes you toward higher tax brackets. Pull too much from tax-deferred accounts too early, and you can inadvertently push yourself into a higher bracket than necessary, paying more tax on that money than you would have if you'd spread the withdrawals differently across your retirement. There's also a second, quieter cost hiding underneath that first one. Higher reported income in retirement can trigger higher Medicare premiums, can make more of your Social Security benefit taxable, and can reduce eligibility for certain tax credits. None of these show up as a separate line item anywhere obvious. They just quietly show up as less money in your pocket, and almost nobody traces the cause back to withdrawal order, because the connection isn't intuitive unless someone explains it to you directly. That Medicare piece deserves a moment of its own because it surprises people the most. Medicare premiums for many retirees are actually tied to income from 2 years prior through something called an income-related adjustment. A single unusually large withdrawal from a tax-deferred account, maybe to cover a big one-time expense, can quietly bump your reported income high enough to trigger meaningfully higher premiums 2 years later, premiums that then stay elevated for the following year, regardless of what your income looks like by that point. It's a delayed, almost invisible penalty for a withdrawal decision made years earlier, and it's exactly the kind of consequence that never gets traced back to its actual cause, because 2 years is a long enough gap that nobody connects the dots without already knowing to look for them. There's actually a fourth bucket worth mentioning here, one that often gets overlooked entirely in these conversations, because it's usually framed purely as a medical account rather than a retirement account. A health savings account, if you have one, behaves differently from all three of the buckets already covered, and understanding where it fits into the sequence can meaningfully change the math. Contributions typically go in before tax, the balance grows untaxed, and withdrawals for qualified medical expenses come out completely untaxed as well, which technically makes it more tax advantage than even a Roth account for medical spending specifically, since a Roth requires after-tax contributions, while an HSA doesn't. The strategic move some retirees use is deliberately paying medical expenses out of pocket during their working years when cash flow allows it, keeping the receipts and letting the HSA balance grow untouched for decades. Because there's no time limit on reimbursing yourself for a qualified expense, that account can function as an extremely tax-efficient late retirement resource, one that's often the last bucket touched rather than an early one, specifically because nothing else offers that same triple tax advantage on the way in, while growing and on the way out. So given all of that, here's the conventional wisdom on ordering, and it's conventional for good reason. Generally, you withdraw from taxable accounts first, tax-deferred accounts second, and tax-free accounts last, with the HSA typically held back even further as a specialized reserve for medical costs specifically. The logic behind taxable first is straightforward. You're already paying relatively favorable rates on those withdrawals, and letting your tax-deferred and tax-free accounts continue compounding untouched for longer maximizes the growth happening inside the more powerful tax shelters. Every year those accounts stay invested instead of being drawn down is another year of tax-advantaged compounding you don't get back. The logic behind saving tax-free accounts for last is similarly straightforward. That money will never be taxed no matter how large it grows, so there's no urgency to touch it early. Let it compound as long as possible, and only pull from it once the other buckets are depleted or once you specifically need it for a reason beyond ordinary income, which we'll get into shortly. Follow this order, and in a simple, static world, you generally minimize your total lifetime tax bill while maximizing how long your money lasts. But retirement in reality is never actually a simple, static world, and rigidly following the standard order can leave real money on the table, which is where this gets genuinely more interesting than a one-size-fits-all rule. The first complication is required minimum distributions. Once you reach a certain age, the government forces you to start withdrawing a minimum amount from tax-deferred accounts every year, whether you actually need the income or not, and that withdrawal gets taxed as ordinary income regardless. If you spent your 60s depleting your taxable account first while letting your tax-deferred account grow completely untouched, you can arrive at required distribution age with a tax-deferred balance that's grown so large. The forced withdrawals alone push you into a meaningfully higher bracket than you'd have faced with a more balanced approach. This is where a strategy called Roth conversion often enters the picture. In the years before required distributions kick in, particularly if you find yourself in an unusually low tax bracket, some retirees deliberately convert a portion of their tax-deferred savings into Roth accounts, paying tax on the conversion now, at a lower rate than they'd likely pay later, in exchange for those dollars becoming permanently tax-free going forward and no longer subject to future required distributions at all. There's often a genuinely useful window for this, the years after you've stopped working but before required distributions or Social Security have started, where your reportable income can be unusually low, sometimes the lowest it will be for the rest of your life, making it the cheapest possible moment to convert. The second complication is Social Security timing. Depending on when you start claiming benefits and how much other taxable income you're generating in those years, a meaningful portion of your Social Security benefit itself can become taxable. Some retirees deliberately draw down tax-deferred accounts more aggressively in the years before Social Security starts, specifically to shrink the account before required distributions arrive, while their reportable income is otherwise lower and there's more room to do so at a comfortable rate. The third complication is simply life, an unexpected large expense, a major purchase, a health event, doesn't wait politely for the theoretically optimal bucket to be depleted first. Sometimes the actual answer to where you pull from involves the practical question of which bucket lets you access money quickly without penalty, not just which bucket is most tax efficient in the abstract. There's a fourth complication worth naming carefully, and it's one that almost never comes up in these discussions, because it isn't really about accounts at all. It's about the fact that a 30-year retirement isn't a single static withdrawal number repeated identically every year. It's a moving target shaped by inflation, changing spending needs, and market performance along the way. A withdrawal amount that comfortably covers expenses in year 1 of retirement won't cover the same expenses by year 20, simply because prices rise over time. And if withdrawal amounts don't adjust to reflect that, actual purchasing power quietly erodes year after year, even though the dollar figure on the withdrawal looks unchanged. Most sensible retirement income plans build in some form of annual adjustment, whether that's a fixed percentage increase, an inflation-linked adjustment, or a more flexible approach where withdrawal amounts flex up or down somewhat based on how the underlying portfolio actually performed that year. Sequencing decisions interact with this directly, because which bucket you're pulling a larger inflation-adjusted amount from in any given year has real tax consequences that a static, one-time sequencing plan doesn't fully anticipate. There's a psychological complication worth naming here too, one that has nothing to do with tax brackets at all. After decades of contributing, watching balances grow, and deliberately not touching retirement savings, actually withdrawing from them for the first time is genuinely uncomfortable for a lot of people, in a way that has very little to do with math. The habits that made someone a successful saver, discipline, delayed gratification, a kind of protective instinct toward the account balance, don't simply switch off the day retirement starts. Some retirees end up under-withdrawing from exactly the accounts the standard order says they should be drawing down first, not because of a tax calculation, but because decades of not touching that money made touching it feel wrong, even once it's specifically what the money was built for. Recognizing that discomfort as a psychological carryover, rather than a signal that something's actually wrong, is sometimes the real first step before any tax-optimized sequencing can even happen. Let's make all of this concrete with a few examples. Picture a retiree with $300,000 in a taxable account, $500,000 in a traditional 401k, and $200,000 in a Roth IRA, needing roughly $60,000 a year to cover expenses. Following the standard order, taxable first, they'd draw primarily from that $300,000 bucket for the first several years, paying modest capital gains rates along the way, while the traditional 401k and Roth IRA continue compounding untouched in the background. Once the taxable account runs low, they'd shift to drawing from the traditional 401k, now paying ordinary income tax on those withdrawals, ideally managing the amount carefully to stay within a reasonable bracket. The Roth IRA sits untouched the entire time, available as a tax-free buffer for either late retirement expenses or specifically for years where an unusually large one-time expense would otherwise push them into a much higher bracket if it came from the traditional account instead. Now picture that same retiree, but this time they retire at 62, 3 years before Social Security starts and several years before required distributions kick in. Instead of purely depleting the taxable account, they use part of those low-income years to convert a modest slice of the traditional 401k into the Roth IRA every year, paying tax on the conversion at a comfortably low rate since Social Security and required distributions haven't started pushing their income up yet. By the time required distributions actually arrive, the traditional 401k balance is meaningfully smaller than it would have been otherwise. The forced withdrawals are smaller and easier to manage, and a larger portion of their overall savings is now sitting in the tax-free bucket permanently. Same starting numbers as the first version, same total lifetime income need, but a materially different tax outcome over 3 decades, purely because of sequencing and timing decisions made deliberately instead of by default. Here's a third version, adding the HSA into the picture. Say that same retiree also has $40,000 sitting in a health savings account, built up over their working years, along with several years of saved receipts for medical expenses. They chose to pay out of pocket at the time rather than reimburse immediately. In their 80s, facing a significant medical expense, they're able to draw from that HSA completely tax-free, both for the current expense and by reimbursing themselves for years of old, saved receipts all at once, generating a meaningful chunk of tax-free income in a year when they specifically need it, without disturbing the sequencing logic running across their other three buckets at all. That flexibility, held in reserve for decades, becomes most valuable exactly when it's needed most, late in retirement, when other options may be more constrained. Compare any of those versions to a retiree ignoring sequencing entirely, drawing evenly from all three main buckets every single year without any particular logic behind it, and never touching the HSA strategically at all. They pay some capital gains tax, some ordinary income tax, and use up some of their tax-free growth potential simultaneously every single year for no strategic reason. Over 2 or 3 decades, that lack of sequencing typically costs real money, not because any single year looks disastrous, but because the small inefficiency compounds across every year of a retirement that might last 30 years, quietly widening the gap between what a thoughtful sequence would have preserved and what actually gets kept. This isn't a minor optimization for people who enjoy spreadsheets. This is the same category of decision as the 401k versus Roth choice. Made decades earlier during working years, a structural decision about when and how you pay taxes, except now it's happening on the other end of the timeline, with the total sum of decades of savings actually on the table. The frustrating part is that almost nobody teaches this explicitly. People get extensive advice, sometimes obsessive advice, about which accounts to contribute to during their working years. Almost nobody gets equivalent, structured advice about which order to draw those same accounts down in retirement, despite the dollar amounts involved often being larger and the decision window being just as long. So here's where you actually stand now. You know the three main buckets: taxable, tax-deferred, and tax-free, and why each one behaves completely differently when you withdraw from it, plus the HSA as a specialized fourth bucket worth holding in reserve for medical costs specifically. You know the standard sequencing logic: taxable first, tax-deferred second, tax-free last, and why that order generally minimizes lifetime tax exposure in a simple world. You know the real-world complications that can justify deviating from that order: required distributions, Roth conversion opportunities, Social Security timing, Medicare's delayed premium penalty, the reality that spending needs adjust with inflation rather than staying fixed, and the very real psychological resistance to withdrawing from an account you spent decades protecting. And you know that this decision, quietly made or quietly ignored, compounds across every single year of a retirement that could easily last 3 decades. And that you don't need to have this fully mapped out the day you retire. You need to understand that the order is a decision, not an accident, and that the version of you who thinks about it deliberately, even imperfectly, ends up in a meaningfully different position than the version who just pulls from whatever account happens to be easiest to access that particular month. That's the entire mechanism. Everything after that is just years of careful sequencing, working quietly in the background, long after the initial decisions that built the savings in the first place have been forgotten.